Welcome, everybody. Thanks very much for coming in to the Roadmap to Successful Property Investment webinar by Property Friends. For the ones that don't know me, my name is Uwe Jacobs. I've been in the property investment game for about 20 years and have run my own company, Property Friends, for the last 18 years. Yeah. There were a number of other people registered, so whenever they come in, they come in. I don't want to delay this, and we're going to get started. All right, so I have to start with a bit of housekeeping, and forgive me, I'm looking at two screens, so if I am not looking straight at the camera, that's the reason why. Bit of housekeeping. We know that technology can play havoc quite easily, so forgive me if something was wrong. If you want to put the camera on later in the Q&A session, by all means, that would be good. If we can keep it off for the moment to preserve bandwidth. Sometimes the bandwidth goes down a bit, and then we run into problems. Please keep your microphone on mute until we get to the Q&A session. I'll endeavor to have a question session in between as well. If you have questions, there is a chat box, should be at the bottom of your menu, depending what system you've got. If you've got questions in between, by all means, put them into the chat. And we've got Lenny sitting in the background. She will monitor the chat box. I will also have a look if I can, and we will definitely answer questions at the end, and or if I can see it early enough, I'll capture it and answer it there and then. We are happy to email the recording to you. So that's the reason for the registration process. We'll keep you informed about other things that are happening at Property Friends, and so you don't need to write feverishly down everything. You'll get everything on the recording. Again, thanks for joining. I know we are all busy. I'll do my darndest to provide great content to you, and let's get into it. I guess the first thing that I need to do is we all have specific circumstances, so they make me do it. Please talk to your own advisors and do your own due diligence before making any investment decisions. Everything that I talk about is gained from 20 years plus property investment experience. I'm in the game myself. I love the game. I'm a dog in the hunt, as I call it. So that's all good. I speak from experience, but please, we can't consider specific circumstances here at the moment for specific people, so do your own research. Okay, so as to what I would like to cover today, the how, and I keep it fairly simple, the strategy, with whom, the why, and what to do next. Okay, the how. Do you want to operate property investment as a business or as a hobby? My suggestion, and forgive me, I am not Australian as such, not born here. I've only been here for, what is it now, 34 years, as you can still tell by my dialect. I'm originally from Germany, and they say of us that we are very direct and that we speak our mind. So allow me to give you the best that I've got, and that is talk to direct and not fluff it up, say it as it is. That provides the best outcomes to you. There's a few more people coming in. Leanne, yes. So Lenny, if you can monitor that people are on mute, please, and that the cameras are off during the presentation, that would be great. Thank you. So do we want to run this as a hobby or as a business? My strong suggestion is run property investment as a business. Hobby hobbies cost money, business makes money if you run it properly. And I guess most people that we talk to want one of three things. They want to have solutions for financial independence. They want to have choices in retirement or leave a legacy. Now, allow me to say quite upfront, in my view, in our experience, you don't do that with one property. That's where we all start, no question. But ultimately, our strategy and the business of property investing is a business where you, in our suggestion, set up a portfolio. We all start with the first one, but really it's about setting up a portfolio of, we suggest, a minimum of 3 properties. So for that, you want to use a system and an unemotional research. I think it was Warren Buffett that said, you cannot control your business, you cannot control your financial destiny until you can control your emotions. So running property investment as a business means that we need to be doing that unemotionally. I have to chuckle and laugh, and I don't get it, why most people buy in the suburb that they live or in the next suburb. Now, to me, property investment as an asset class is no different than any other asset classes. The only reason why I have chosen property investment, and why, in fact, most of the world's wealthy business have started in property investment and through property gains, and have made the big money on that, is because the asset class is very forgiving. It is very stable. So yeah, do unemotional research on-site and off-site. We start with off-site research. That's how we define the 3 to 5 markets that we go into per year. And then it is really, really important to either go to the location yourself or get somebody that you trust to check it out for you, because nothing beats the touching, the feeling, the smelling, the getting the vibe in the market. We the picture that you see on the left, oh sorry, depending on how you run it, the picture that you see on the presentation is the property in Midway Point in Tasmania. Now, you can do all sorts of off-site research, but you cannot find out what is the aspect of the property, what will happen in a new development when the other houses are built. Will my view, this magnificent view to the ocean, be blocked? For that, you need to go on site. So, strong recommendation, go on site or have somebody looking at the location, at the orientation, at the situation in the market. Systems make it possible to have a recurring quality outcome. Why else in industry were QA systems set up? And again, in a system, you can risk mitigate, you can keep the risk low. That is what we're after. We want to keep the risk low, have a fairly predictable outcome, and want to be able to duplicate that outcome. If something works, let's do it again, Sam. So then that provides us with a predictable and risk mitigated outcome. As to the strategy, I want to cover a couple of points, and one of that is the old tug of war between yield, which is the rental income, and the capital growth, which is the increase in price of the property. Let's a tug of war where philosophies go apart and many different people have many different philosophies. I'm going to cover that a little bit later in detail because it is one of the most important decisions that we all have to make. What do we have? What do we go for? Yield or growth, or in fact both at the same time? Then time frame. Property investment is not a get-rich-quick scheme. Don't let anybody tell you that there is such thing. I don't believe there is. And hence we suggest a 5 or better 10-year property strategy. And I keep hammering the word strategy or plan or system. The risk versus the reward in the asset class property investment is really, really great. The risk is fairly low as long as we do our research, and the reward is fairly high as long as we can have enough time to wait for the capital growth. And that is again a reason for the yield and growth equation, but I'll cover that. What's the right deal for you? Now, this is where I'm a big believer in a personalized strategy. There is no right for everybody. There is no one shoe fits all. We all have different circumstances, different time frames, different risk profiles, different disposable income, different ideas. So in my view, in my humble opinion, it needs to be a personalized strategy that we discuss with our team. For that purpose, we're offering a 30 minutes discovery call. You can book that in, and we'll put the link into the chat so that you can have that. Then if you can look after that, please. So that's a free bonus for the people on this call. I'm happy to make that time available because I want to get to know you a bit and want to understand and find out what is the starting point and where are you at and what do we want to achieve. So let's go into the link is in the chat now. So if you want to copy that, by all means. Let's go a bit into more why high rental yield, which is what some people are advocating. Rental yield, the rental income, the weekly or fortnightly or monthly rental income is the short-term money. That's the money that we need for the cash flow to be able to finance the property, and hopefully, if done correctly, there is enough rental income for the property to pay for itself completely. Because otherwise, if you go into large negative gear, you influence your lifestyle. I have seen people that bought in Sydney, and typically it is the larger cities that have got very high prices to buy in, yet very low rental yields. I've seen people in Sydney that had rental yields, and in Melbourne for that matter, of 2.5%, 3.5%. That means that you're paying $500 to $1,000 a month of your after-tax monies into the privilege of holding a property. That ain't fun. And heaven forbid, we get into a market where the situation is like in Sydney, where 7 years there was no capital growth. And you sit there and 7 years pay $500 a month out in negative gear of your after-tax income in the hope of getting capital gains. Now, isn't it a much better strategy to look for a property that has got high enough rental income so that we can live our life normally, that the income of the property carries the total expenditure of the property? Now, we use the tax deductions and non-cash deductions to cash flow the property. No problems with that. But what I'm suggesting is $500 a month in negative gear will certainly influence your lifestyle. It will cut short or eliminate, make impossible holidays, dinners out, and so on and so forth. And even if you're one of these high disposable income earners, can you do it for 2, 3, 4 properties? I don't want to be in that situation. And this is where people go and get into hot water, and in fact go underwater with their cash flow. That's the reason why we're suggesting have high enough short-term money, have high enough rental yield that the property carries itself. And with the current interest rates, 5% will do. But if you don't get 5% return on the gross rental income, why do it? It also makes a lot of sense to get the high rental yield, 5% and above, for financing purposes. Again, let's go back to the $500 a month negative gear. Your financing for the second or third home gets really, really challenging when you've got high negative gears. Let's set up at the beginning for the portfolio approach, because that will get us the financial independence, the choices in retirement, or the leaving a legacy. Let's set up right from the start for the right outcome, for the right end. So the rental yield is the small income. And even if you had, say, $200 a month in positive gearing in rental income more than all expenses, times 12, that's $2,400 a year. That ain't much income. But if you have a property, let's say of $500,000 value, which is the sort of area that we like to purchase in, 500 to 550,000, then having a, say, only 5% capital growth is $25,000. So you can see that the rental income is the small money, but we need the small money, the short-term money, to be able to cash flow the property. And that's why that is so important. Now, why are we going, or why are some people advocating high capital growth? Well, that's the long-term money. That's the money that comes in over time by means of capital growth. And that's the lifestyle that is afforded when you've kept the property for a number of years, and or in a portfolio approach, when you can retire debt, you sell one out of, say, 4, sell down to 3, you retire your debt, and that's what provides the lifestyle. Refinancing is easy when you have got capital gains, or easier, I should say. So let's say that we've kept the property for 4 years and we've got, I don't know, $80,000 to $100,000 in there. We can refinance and get 80% typically of that money back as the investment for the next property. Now, that's the way to leapfrog from one into a portfolio, by simply taking the equity generated through the house or houses, refinancing, and then using that money as the deposit for the next one. The capital gains, no doubt, as I've already illustrated, is where the big money sits. Now, why both? Very simple. The reason for both is you want to have, and typically, I should say, typically there is a seesaw effect between capital growth and rental yield. The more capital growth, the lower the rental yield. The higher the rental yield, the less capital growth. So looking at that, It is no good to go for either extreme. So why not go for a balanced approach where you have enough rental income that the property pays completely for itself under tax deductions, but where the capital growth is kept at the maximum possible under these circumstances. That's the golden goose that lays the golden eggs, because you can live normally as you've done before the investment. And if, heavens forbid, the market wasn't going to move for 7 years, you can just sit there. That's the risk mitigation. That's what a lot of people forget. A risk mitigated approach. Why the roadmap? Why the system? Why the specific and personalized plan? Because let's not forget about it. For most of us, this is the biggest investment that we are making other than our family home in our life. You don't want to muck that up. And in a business, we have a plan. We have a roadmap. We think about what we're going to do before we do it. So that is the really important part. We talk about 3 phases: the accumulation phase, where you get to build your portfolio as fast as possible; the consolidation phase, where you have the capital growth, looking after the benefits, looking after the capital growth, looking after the increase in value. And then 3 is the repatriation phase, where you have had enough capital growth, where you've achieved your goals, and where the roadmap has been fulfilled. So then you sell down or retire with debts. That's again a very personalized strategy, and there's many ways to skin a cat. But there are definitely 3 distinct phases. Now, there's nothing like a case study. Agree? Okay. So the property that you see on the photo is actually a property that we did in 2018, 3.5 years ago. A house and land was purchased for $360,000. The anticipated rent there was $390. That is a 5.6% yield. This location is in Hobart, in Tasmania. So see, again, we don't start anything until the offsite research tells us we can get at least 5% rental yield. Now, that's all nice and good. Where does it sit today? Today, the value is $550,000. The actual rent is $530,000. Again, above or around 5%, 5.1%. And the actual rental yield on purchase price is 7.1%. That, ladies and gentlemen, is a great property investment. Now, can we do that every time? No. But we have been very successful over the 20 years that we've been doing it. So nobody can guarantee anything in investments, but you can risk mitigate, and through your due diligence, make it highly probable. I often get asked, what's a hotspot? How do I select the areas? Well, I'll give you a hotspot. A vacancy rate of 0.4% is tight as a drum, as we call it in the business. Between 3.5% to 4.5% is generally considered to be a balanced market. This area, and hey, I'm going to give it to you, Cairns, Far North Queensland. And again, this is case in point for knowing the areas intrinsically and in detail. The rental vacancy there, depending on the suburb, trends between 0.8 to, actually there are 2 suburbs in the south which have got 0% rental vacancy. I've never heard of that. So it's extremely tight, extremely favorable to the landlord. In average, 0.4%. So that is definitely a great market to go into. The asking price last quarter of 492 went up by 10.6%. Another great indicator. The stock on the market with 73 properties is at a 10-year low. And the weekly rent has gone up to $501 a week, or in the last quarter, have gone up by 11.3%. Again, note the point, the rent is higher than the asking price. Now, this is the median asking price, but still, have enough rental income that the property pays for itself completely. So that is a terrific market according to the offsite research. Now, on top of that, when you go on site, you will get to know the situation about the industry, about the status of the economy. Are there any shops built? In this instance, there is a great shopping center going in that will be finished by the end of the year. The highway is being duplicated, $560 million infrastructure cost being spent. And there is a retirement village close to where this development, where this location is. These things can only be found out, can only be known when you go on site. So strong recommendation, do go on site or have somebody checking it out on your behalf. Of course, we do all of these things for our guys, but that's by the by. Local research and verification of the figures is really, really important. Okay, allow me to indulge myself for a moment. With whom should you be doing business? Go with people that have got experience, long experience in the business. We've got 20 years. 76% of our business is returning clients. That figure's out of the world. So we're doing something right. And that is our portfolio approach and our property friends approach, by setting up long-term relationships and doing the right thing. That's what I call it. We have a 7-step success system that provides accurate, unbiased investment guidance, training and opportunity, and that mitigates risks. So we can get you to the golden goose that lays the golden eggs. We can help you to train how to do it yourself if you want to, and we mitigate risk. Full disclosure, we get paid by you. This has to be one of the biggest bugbears that I've got. And yes, I have a bee in my bonnet about getting paid by the purchaser. Think about it. 95% of the market gets paid by the vendor. Now, if I get paid by the vendor of the land or the builders, whose interest do I really have at heart? Generally speaking, the person that pays me is who I look after. It's the same with everybody, everywhere. That's the reason why we 20 years ago made the strategic decision we want to be paid by the purchaser, by our clients. Because then I can also look you in the eye and say, you pay what I pay. And we are in the same markets typically that we are all in. Ulla and I are part of the same gang that is purchasing, typically. So we get paid by you, the purchaser, completely separate to the deal, and there ain't a dollar that goes in a brown paper bag that you don't know about. There is no hidden fees, no hidden commissions. I think that's really important. And that's also why we 20 years ago decided on the name of Property Friends. You do the right thing by your friends. Okay. Check out our client feedback and testimonials. Allow me to play one testimonial quickly. Dion and Jacinta is a young couple that joined us. Let's have a quick look.
G'day, I'm Dion and this is my wife Jacinta. We've just recently completed our very first home with Property Friends. That house is in Townsville. We've gone and inspected it and seen everything that's come together over the period of time during the build. we're very, very happy. With all the advice that we've been able to get through Property Friends, we've certainly had the encouragement and the confidence to pursue our investment path and tackle another one, which will be in another state, which will be ready very soon. Through Property Friends, we've been able to access...
Oops. Yeah. So I cut it off there. They've been able to access great deals on the good market. So yeah, look, why do it all? It's all about you. Again, I emphasize the point that it is a personalized strategy. Get the information, do the due diligence, and be happy with the research that you've done. There are a number of considerations that need to be done. Where are you at? That includes, for me, a knowledge of your assets and liabilities. So what do you owe and what do you own? So that we can establish our net worth. You'll need to do all of that for the bank anyway. But doing it yourself is better. It also includes a cash flow. So what's my money coming in? What's my expenses? Because that way we can see where we're at and what markets we can tackle. And definitely, what's the end goal? What are you after? Are you after financial independence? Are you after choices in retirement? Or are you after leaving a legacy? That determines how to best optimize for that outcome. And then the suggestion is to develop a customized multi-property strategy. Again, we are offering a discovery call. The link is in the chat. I'm happy to put 30 minutes aside initially free of charge to have a chat and to see where are you at, what do you want to achieve? Because then and then only can we develop a meaningful strategy. Makes sense, doesn't it? Okay, I have rambled on enough. Let's get some questions. If you want to, we are a fairly small group today, which is fantastic. If you want to open the microphones, I'm okay with that. And you can shoot questions at me straight away, or we can also see. Lenny, did we have any questions?
Yes, we have a few questions in the chat box. Yeah. How do you ensure a good quality build?
That's a good one. Especially when we are not necessarily on location. The answer is very simple. We are wholesale buyers. First of all, we do a lot of research and make sure that we get to know the builder as good as we can before we place the first job. But the best thing about being a wholesale buyer is think about it. If I can give you as a builder a set of 3 to 5 dwellings now to build, and then in 6 months we do another set of 3 to 5, will you be able to look after us better than the purchaser that only does one? Will you risk doing the wrong thing to the buying group, to a channel that can give you a fairly substantial flow of business? Now, naturally, we also strongly suggest, and this is not mandatory, a building inspection at the end. Again, we go above and beyond. We arrange that for you if you want to, and select strategic alliance partners that know how we work and that know us and that give us a good deal. I don't mind admitting I like good deals, and provide the service that we're looking for. Generally speaking, I'm on site myself 2 to 3 times during the construction process because we travel a lot. I want to have my feet in the market. I want to be in the market to be in the market. I want to know what the market is doing. Hence, every 6 to 8 weeks, I am on a trip to somewhere or another, checking up on how our property is going, how the area is going. So that's how we make sure that the builder does the right thing. I hope that covers it. Any other questions, Lenny?
Yes. LVR, is it worth it to go over 80%? And what is your view on LMI?
Okay. Loan to value ratio. Okay. Maybe I need to explain for the ones that are not that into property as yet. Up to 80%, you don't have to pay lender's mortgage insurance, LMI, which is an insurance for the banks, not for the purchasers. That can get very expensive. If you go for, let's say, as an owner-occupier, you can go to 95%. At a $500,000 property, that will add $15,000 to the cost. So if we can avoid that, I suggest to go with 80% LVR, loan to value ratio. That means that you need to get 20% of deposit yourself. Now, the bugbear is, let's stay with 500,000. That means you need to come up with $100,000 of your own capital plus cost. Especially the young'uns that don't have a principal place of residence yet. And yes, there are a number of the younger people that do rent vesting, may find it difficult to get to $100,000 savings. Now, I don't have an issue to go to 90% LVR and pay lender's mortgage insurance if that gets me in the market, full stop, because the market can quite easily outrun you in value increases, as we've seen the last 2 years. Or if it gets me into the market 2 or 3 years earlier. Again, makes sense to me to pay $10,000 in lender's mortgage insurance if I can pick up, let's say, only 5% capital increase on 500,000. If I can pick up $25,000 in 1 year against a $10,000 increased cost, makes sense to me. Plus, property investment, when you do it in the beginning, is a forced savings plan. We get to know and understand a regimented approach that helps us building assets. And that is what it's all about. Now, so that was the LVR and LMI as well. So in essence, if it gets too challenging, there is a possibility that the market will outrun you. And hence, yes, in certain circumstances, I'm okay with getting into 90% LVR. But again, that's a personal thing and needs to be looked at carefully for each situation. Anything else, Lenny? Or if anybody wants to have, wants to place a question, Marcus, John, Leanne, by all means, just click on the microphone and we can have a chat. I'm open to that. Was there any other questions, Lenny?
We have one more. Can you assist with other resources?
Yes, we are in the market ourselves. We practice what we preach. So any resource that you will need, we need ourselves. Now, I'm a big believer in group deals. So we offer our resources to the rest of the team. 1, as a team, we're stronger. 2, we get better service. And 3, usually better prices. So we can give a referral to a strategic alliance partner, to a mortgage broker, to insurance to a building inspector, to a rental manager, to a conveyancer, lawyer, because we need all of these services ourselves. So yeah, that's what we're really good at. And to work with strategic alliance partners that know how we do business makes it so much easier to do business and creates a better outcome. Now, again, I stress the point, there is no hidden commissions, no nothing that you don't know of. We get paid by the fixed fee that you and I negotiate. So that's the way that we like to do it. Leanne, okay. Yeah, look, Leanne, she's saying that she's not quite in the position to do something yet. Again, if you wanted to book into a strategy call, I have got a training program that can set yourself up for a good plan to get into the situation to invest. Okay. Yeah, look, my pleasure, Leanne. It's been my pleasure to help, and do stay in touch. Okay, it's 10:02. Any other questions? Otherwise, feel free to also take advantage of the strategy session, the discovery session. I'll make that available. I think it's a lot of fun, and that way we can get to know each other and develop a personalized strategy for you. Was there any more, Leanne? Lenny, or are we through? Unless there is any live questions.
I'll give you one, Uwe.
Yes, please, Marcus.
We're looking at 5.5% general returns on these sorts of properties.
Yep.
Is there something like NDIS or something like that that's got a larger return if you just want a cash splash?
Absolutely, and as you've seen with the with the property in Tasmania, there are many ways to increase the return. Usually, they come also with increased risk or with increased capital requirements. So, for example, we're at the moment structuring a duplex, also in Cairns, where I expect the rental yield to be 6.5% off the bat now. You can go into specialized investments like an NDIS, where you can get, I say, 8 to 10%. But there is more capital required. It is more complex. And very few people will tell you that there is also more risk involved, because you are creating a very specialized property. And that means you cut down on your demographics of tenants, and you increase the risk. But yes, and that again, Marcus, great question, thank you, is part and parcel of the personalized discussions. I have kept this webinar fairly simple. If you are a sophisticated investor and or have been in touch with property investment, with investments in general, by all means, let's take the Ferrari. But before we do that, let's all learn how to drive in the first instance. Does that cover it?
Just about. I'll follow one up on the NDIS.
Yes.
I know it's a specific building because it's catered for the clients.
Yep.
Do you get a very long-term government contract such that you 20, 30 years worth of rental guaranteed on something like that? That's
actually a misnomer. And Marcus, there is a lot of shenanigans that are going on in the market by the marketeers, as always, as usual. The rental contracts are with the specific tenant, and you can set up any duration really for the rental agreement. The issue that very few people will tell you is that as per the NDIS guidelines, the tenant or participant can effectively terminate within 2 weeks. The scheme, the system, the government system is set up for a 20-year period. So in an ideal world, you set up a tenancy for 20 years. I have not seen anybody who's been able to do that. Now, mind you, the system has been in place for about 3 to 4 years in its current form and is evolving as we speak. I'm going to let you into another secret, and that is that there is quite a few NDIS properties that are not tenanted and that are finding it difficult to be tenanted. There are also some marketing companies that guarantee returns. Now, that is no different than if I was to guarantee a rental yield to you. One, I've got to cover the risk. Two, you can bet your sweet bippy that they have put in lots of money for themselves for guaranteeing returns, because it is a risk. But moreover, what's behind the company that guarantees the return? So the short answer is, in theory, the system is set up for a 20-year duration, but the actual rental contracts are between the people and the SDA provider. And we typically set up 1 to 3 contracts, 1 to 3 year contracts.
Okay. Perfect.
Thank you.
Thank you.
Anybody else? Otherwise, I call it quits. I hope this information has been valuable to you. I hope it gave you a bit of an edge. As I said, actually, I'm going to make one more offer to you, and that is, I've written a book. If you want to take advantage of a nice discount, in there are the 7 steps that I have developed and have found to be necessary over the last 20 years to ensure success in property investments. There's a discount in there, so just you can book it online on our website, and it really is the roadmap. It is the things that you need to cover off on. Other than that, by all means, book the strategy call and have fun. Thanks very much, and I hope to be in touch. All the best. Bye-bye. My pleasure. Thank you.